Welcome to the Investor Fuel Real Estate Investing Show, where I interview the nation's top real estate entrepreneurs, industry leaders, and other amazing entrepreneurs to help educate and inspire you to take your business and your life to the next level. My goal is to add tremendous value to you during every single episode of this show. If you get value, I'd love it if you subscribe on your favorite podcast player, subscribe on YouTube, and my very favorite, please share this with your community so we can impact even more entrepreneurs. Let's start today's show. Hey, everybody, welcome back to the show. Today, I'm here with Ryan Stewman and Kevin Jerome, and we're going to be talking about the 50-year mortgage that just rolled out, what it means for real estate investors, what it means for the economy, and a bunch of stuff related to kind of affordability of housing and where we're going from here. So, guys, welcome to the show.
What's up, Mike?
Yeah, good to see you, buddy.
Kevin, welcome back to Texas, sir.
I don't see you that often, Ryan, but both of you guys, I saw you twice in 2 weeks, or twice in 1 week, really. Last week at Investor Fuel, and Kevin came out to my ranch.
I mean, just good luck.
We talked about Ryan's ranch a lot. We got to have a shuttle that's moving people back and forth, maybe.
I met your son last week. You introduced us.
Yeah,
I
yeah.
sat there and talked to him for about 20 minutes.
Yeah.
And great kid, by the way.
Yeah,
and really interested. And I could see that he's been like practicing what questions to ask. He's like, you fixing flips or you long-term hold? Like, all right, I like it, you know? And got to talking to him for about 20 minutes. I didn't realize that you lived here. I knew you lived in Dallas, but I thought you lived like on the other side, like the Fort Worth side. And for some reason, I thought your ranch was in Granbury. I don't know why. And so he was like, no, the ranch is in Van and we live in Louisville. And I'm like, oh man, we could have, I thought
Castle
you lived
Hills,
a long ways from here.
Yep.
Because the event was in Fort Worth. So I'm just like, you guys live pretty close to here, right? And he's like, no.
Yeah.
Yeah, that was a sweet ranch. So not gonna lie, that was a good.
Yeah, we had a good time out there. So, hey, before we get started, obviously a lot of people know who you are, right? But would you guys introduce yourselves and a little about your background?
My name's Ryan Stewman and lived in North Texas my whole entire life. I own a few companies in the lending space, roofing space, and insurance space. And then I run a large mastermind, one of the largest mastermind networks out there called Apex. Been doing that for 15 years, long time before it was the cool thing to do. And this is my man, Kevin,
So that's a good intro. So yeah, my name's Kevin Jerome. I originally from New York, moved a lot, first generation American, finance. I've been in the finance space for a long time. My mom was a former stockbroker. And I knew once I started going to work on Wall Street, I was like, man, I got to be like that, man. All the money she's making. But yeah, got into the lending space, been learning a lot about real estate, really enjoying the process of building these relationships, coming to Texas damn near every week at this point. And yeah, just been in the finance space now for 10 years. Yeah, it's been
wait. So you and I have known each other for a year and a half or so, and been working together. And you're first generation American. Like, where's your family from?
So my family's from Haiti.
I had no idea.
Yeah, my family's from Haiti. Everybody want hey, look, we're gonna get 9 to 5. I knew I was gonna be in sales. I was a kid. When I moved to Georgia, I was like, man, I need to make some money. So my family was like, well, go cut some grass. I'm like, I'll go cut some grass. But I also started doing some upsells. Like, hey, I'll cut your grass and I'll do, I'll walk your dog or something. Before you know it, football season comes around. They're like, hey, Kevin, we got these coupons to sell. So I'm like, wait a minute. So if I sell enough of these coupons, can I keep it? He's like, yeah, you're not going to sell that much. My cousin and I, we made a whole plan. I was like, yo, we're going to split the neighborhood in half. You get half the neighborhood, I get half the neighborhood. We made so much money. It was crazy.
That sounds like what they did in The Sopranos. They split up parts of town. Like that's your book. That's your book of business over there.
It's crazy. It was after that, right? 10 years later, my family's in the same neighborhood. When I go back, the neighbor's like, Kevin, I knew you're gonna be in sales.
Yeah,
they say that about me.
Lifelong, always hustling. Yeah,
I knew you was gonna be in sales.
That sounds familiar. Yeah. So let's talk about this 50-year mortgage. It's kind of come out recently. A lot of people it's obviously gone viral over and over again. You've done some videos on it. It's right when I saw it, I was like, obviously as a finance guy or a real estate investor, there's a bunch of stuff that happens to us, quite frankly, as real estate investors. And I'm like, I know that's not good for the dollar or the country long-term, but it works for me now. Right. I'm like, that's my first thought of a lot of folks in Investor Fuel have houses that are just sitting there.
anything to make housing more affordable or subsidies or anything. So they, quite frankly, I hate, but they're good for business, right? It's always a balance. But what are your initial thoughts, Ryan, on the 50-year mortgage?
Well, I don't think it's a solution to affordability at all.
Yeah.
And I don't think, here's the 3-card Monty or the magic rabbit in a hat trick that people do in finance. Okay. I've been in the finance industry for 21 years now, and that dates me a little bit, but I've been seeing a subprime boom and a housing boom and a crash and all that a couple times at this point. And, here's what happens. They get you thinking about interest rates. They say, Mike, 6% interest rate. Mike, 6% interest rate. It reminds me of the old story of Zig Ziglar used to tell about, he goes home first time for Christmas. The wife is putting ham in the pan and cuts the ends off the ham. And he's like, that's the most delicious part of the pig. Why are you cutting that off? She says, I don't know. My mom does it. Ask her. Goes and asks the mom. She goes, I don't know. My mom did it. Go ask her. Goes ask the grandma. She goes, I never could afford a pan big enough to fit the whole ham. Right. And so I say that because people will say, hey, when you go to the bank, make sure you get a low interest rate. And so the banks are smart, right? So they know everybody's focused on interest rate. So where they get you is the terms.
Sure.
Because what you think is, oh, it's a 6% interest rate. That's 6% of the balance annually, interest first over 30 years.
Yeah.
That's really more like a 50% interest rate when you all add it together.
Yeah.
It's actually more like 60%. And that's over 30 years. And now if you look at my grandparents and probably your grandparents, they took out 5-year mortgages. Yeah, right. And then sometime in the 70s, they moved to 10, 80s, 15. I remember when I bought my first house on a 30-year note, my grandpa's like, I can't believe people are financing for 30 years. And we will say that same thing in the future when people do it for 50 years. Yeah. But here's the other side. I was in the mortgage business when the solution to affordability in 2007 was a 40-year mortgage. They were predatory as all get out, because what they would do is a 40-year amortization on a 2 or 3 year arm with a 2 or 3 year prepayment penalty. If you don't know what that is, that means that it is spread out like it's 40 years, but it has a low fixed interest rate for the first 2 or 3 years, and that interest rate adjusts up. They never go down. They adjust up accordingly. So what happens is if you've spread that out over 40 years and it's interest first, that means that, or 50 years, whatever it is, that additional interest that you're paying on that lump sum for an additional 10 years and 40 years instance and 20 years in a 50-year existence, that you have to pray, because there's no other way to do this. You have to pray that the appreciation in your marketplace outpaces the cost of the interest. So in other words, if you're paying 6% interest a year on the price of that home, you have to pray. And the only way that you're ever going to build equity in this thing is if the prices of properties in your area increase more than 6% a year.
Yeah.
If not, you're going to be in serious trouble, because 15 years from now, you go to sell your house and you don't even have enough equity in it to pay for the 6 to 9% in closing costs and real estate agent fees.
Yep.
And that's a serious concern. The other thing they did in the 40-year mortgage was they said, if you take a 30-year mortgage, the interest rate was, let's say, 5%, right? But if you take a 40-year mortgage, bigger risk on our end, the bank. So it is a 5.25% hit because you're extending it out. Just like if you go buy a car, the best terms and rates are on 2 to 3 year notes, right? Most people take a 5-year note out on a car and they're still pretty favorable. But the guys that take the 72-month loans, I've done that on Lamborghinis before, like it's all interest first and you're not really knocking anything off of it, right? And so it's the same with houses. Imagine paying 10 years on a home and then you go to sell it and it costs you money to sell it because you have to pay for title, origination, closing costs, and 3 to 6% real estate fees. And you're like, I lived here, I might as well have been renting, which brings me to my point. I know it's a long-winded start of an answer here, but Klaus Schwab, they're now retired, but former leader of the World Economic Forum, is famous for saying you will own nothing and be happy. And this is a great example, because if your house isn't paid off, you don't own it. And these days with property taxes, even if it is paid off, you technically don't own it because you still have to pay for it, or you could lose it to some sort of entity.
Yeah, I think I was telling you last week, our rentals, we have a rental portfolio here. It's for the most part paid off. I mean, they should be cash flowing well. The first 5 months, this is in Dallas, Fort Worth, Texas taxes are high, insurance is high, right? 5 months of rent for us to break even just to
That's
pay
right.
off
I remember
taxes,
seeing that.
taxes and insurance a year. Yeah. And so, I told you I got a couple houses back yesterday.
That's if nothing bad happens.
As if nothing bad happens.
By the way, Mike
bad
says
stuff happens all the time.
these are paid off.
Right.
So imagine if you had any kind of a mortgage
Yeah.
attached to them. These are paid off in Dallas-Fort Worth, one of the hottest, if not the hottest market in the nation.
Yeah. Yeah. It's tough to make
That's
them work
crazy.
now. Yeah.
So wait, if we're looking at 50-year mortgages now, and you said your grandfather said, "Man, I can't believe you got a 30-year." What did he have back in the day?
10 to 5 and 10-year mortgages
How do we go
at 20% interest, by the way.
So how do we go from 10 to 30, now 50?
To make housing more affordable.
The truth
Ultimately, right.
is the banking institutions are some of the largest lobbyers and financiers of our political action committees and our politicians that make the laws here. We've seen the too big to fail when they gave, what was that, $500 billion or whatever it was to quantitative easing to help every bank but Chase. I remember just seeing Jamie Dimon speak this week, and that was one of the things they said. You were the only bank that didn't take a bailout. Ford Motor Company was the only automaker that didn't take a bailout. And surprisingly, those are the two top automakers. You keep the government out of your business, you can prosper a little bit better. But think about that. If I'm a banker, I'm a Jamie Dimon type of person, I'm an economic advisor to Trump, I'm not going to say, well, we could lower interest rates and not profit as much as a bank. That would be absurd for them to say something like that, right?
Yeah.
Instead, they go, well, we just give them a 50-year mortgage. The payments will go down a little bit, right?
You would know this, Ryan. If somebody sells, let's just say they sell a 50-year over a 30-year, if they sell a 30 over a 15, the mortgage brokers make more money, right?
No.
Okay.
So there is something called the Dodd-Frank Act that was passed in 2010, and QM is what they call the loans that are done for consumers. So it's the CPFB, the Consumer Finance Protection Bureau, right? CPFB, Consumer Bureau of Protection Finance, whatever the hell. And so what they did was they changed the commission for loan officers. A lot of people don't know this. Back in the day, loan officers were like real estate agents. They make a point of origination and 2% yield spread is what they called it on the back. So they get 3%, and you're in control of that. You raise the rate, you get paid a little more. Dodd-Frank got rid of that. Now everybody gets paid on their volume, so it's basis points. You originate $1 million, you get 50 basis points of that.
I assume.
And so it's not based. So, but what will happen is there is a cost passed on to the consumer 1,000,000%. So the mortgage broker, the guy that's your loan officer that you have a relationship with, the guy or gal that does that, they're not going to have any upside to selling you a 50-year mortgage, right? Matter of fact, there's probably the good ones will tell you not to take that. They would say you need to afford one at 20 or 30 years, right? You're going outside of your budget. The other part of that, though, is that the bank that services it. So there's levels to mortgages, right? So there is the broker you go to that you put your application in. They typically have a correspondent line of credit or broker it out to somebody who actually funds it. Then that company pays the money, pays the closing costs, pays the commission, and then it either sits on it in a portfolio and has a third party, what the investors would think of as a property manager, but is a portfolio manager that collects all the payments on there, sends the disbursements to where they go within the investor pool, and they put millions of those together and call them mortgage-backed securities. The people that make money are not the sales staff and not the brokers. It's going to be the servicers, because now they've got 20 more years of servicing to do.
Yeah. I never knew that. And I always assumed my very first house I ever bought, not even as an investor, when Lindsay and I got married, we bought a house in Louisville here as well. I've flipped hundreds of houses. I've only owned 2 like personal. Well, I guess 3 with the ranch now. But our first house, we went to sign. And we told them we want a 15-year mortgage. This was around 2005, 2004 or 5. And we told them we want a 15-year mortgage. Everything was on track, and we got there, and they have all these documents. The first time I've ever signed for a mortgage. There's it's overwhelming, like all the paperwork, right? And
even more so.
And they were 30-year mortgages, and there are like a couple people there helping us sign. They're like, well, we can go print everything, but it's going to take us like 2 hours. And they're like, well, you could just make a bigger payment, And I was always like, yeah, you're just getting paid more. Like literally, I've thought that since that moment. So
matter of fact, like when I was doing mortgages, I would actually get paid more on a 15-year note because there would be less hits. So you could,
Yeah.
it would be more if I was really trying to make some money, it's advantageous for me to sell you that 15-year note. Cause
Yeah.
like, let's say the interest rate 6% on a plain Jane 30-year fix, right? It might be 5.5 on a 15-year fix, right? Which I could then sell that to you at 6% at 15 years. And that's where I would make the most money, right? Because of the shorter term, I got a bigger discount because the bank's less risk on their money. But yeah, the people who stand to make money on this the most will be the servicers, because now they're going to be servicing something for 20 more years. And the servicers sit on the escrow accounts. So they accrue interest on those escrow accounts and then make the disbursements. And, it stays in your account or whatever until you sell that house. But, sometimes property taxes go down. Sometimes they go up. There's people that never close their accounts out. Like, think of all the apps that we have where we left like 20 cents in there because nothing that we could buy in the app was 20 cents and we didn't want to put more money in it.
Yeah.
Like gift cards. Dude, that is a gazillion dollar,
for sure. Yeah.
way to make
somebody's
money.
benefiting from all that float. you know?
Absolutely.
Yeah. So we don't know what this will look like yet. The question is, will they have 50? You think they'll have 50-year mortgages for investors? Kevin, what do you think?
When we were just talking about the 50-year mortgage for the everyday consumer, that made me think about on the investment side. I think it's going to take us some time before we get to that point, because anytime on the investment side, you're no longer thinking like consumer, you're thinking about, well, how can I maximize, what I'm going to keep in my pocket, but at the same time, how can I make sure that this is really good for me, right? And then, like Ryan said, at some point, is this really the best thing for the consumer? Is this really the best thing for me as an investor? Because if we're breaking down the numbers, and let's be honest, not too many people can break down numbers like you're Ryan, are they really looking at that cost, or are they looking at how most consumers look at it? Like, oh, it's 50 years. Hey, it's cheaper right now. But
Right.
when I need to sell that property, heck, what does it look like when I try to do a 1031 exchange? Do you really have that value?
Yeah. A lot of investors, they say things like, marry the house, date the mortgage, stuff like that. So I could see that being next. Like, well, just date this rate for a little while, and when rates come down, then you refinance into something else, or when it appreciates, then refinance it. Like, people will start to find ways to justify that, right?
Well, like I was saying earlier, you're going to have a rate hit for this. So if the interest rates are 6%, they're going to be 6 1/8, 6 1/4 for a 50-year, 40-year term. I did the math on this yesterday with the help of ChatGPT. On average, at a $280,000 home, which would be cheap here and in most markets in the U.S. at this point, that's an average of $300,000 to $600,000 more in interest that you would pay over the term. Okay. So if you've ever looked at a truth in lending statement, borrow 400, 1.2 is typically what you've actually financed over 30 years. So add another 20 years to that, you can add another 50% of, what the actual price was that you're coming in on that. Cause it's, again, 6% a year for 20 years. What's 20 times 6? 120. This is 120% just right there.
Yeah. Yep. So we'll see how this plays out, right?
But if I'm an investor, okay, then it's different. If I'm a consumer, I have to put 5% down, maybe no percent down to buy a home, right? Veterans can get in for 100%. It's probably a terrible idea for them. But an investor putting 20 to 25% down, there is some equity already there because of our cash, okay? But if a investor is trying to, play the, hey, I'm going to hold it for 10 years and sell it and make profit, probably not, because it's going to be so much front end. But if an investor like Zach Sasser, who is a good friend of mine, he's 26 and he probably owns 7 or 8 homes now. He's still in his 20s. So he could buy something for 50 years and sell it 30, 40 years from now. If just like a 401k, hey, I'm buying this house and I'm not touching it till I'm 62 and a half. You know what I mean? So, and at the longer terms, they might be able to cash flow it a better, right? Because it is going to be a cheaper payment. So if rents go up and that payment's locked in, at some point, maybe interest rates go down and they can refinance it from 50 to 30. As an investor, it's something to look at. But here's what I think. I don't think they'll roll it out
Right.
to investors for a while.
Probably
though.
not.
It'll be a special finance, consumer only, high qualifications, 30% DTI, that kind of stuff, debt to income ratio. But once they get it established and have a baseline, then they'll open it up to probably 20 to 30% down on those 50-year mortgages, which isn't too outrageous, and it might work for cash flow. But if you're somebody who's like at my age, 46, it's probably not a good idea. But if you're, 40 and below, yeah, you could probably run a 50-year mortgage and pay on it the next 30 years as a long-term retirement play.
Yeah, I think investors will find a way to make things work. There'll be some investors that make it work somehow. If you were counting on a lot of high appreciation, maybe. Like the appreciation, I had a mentor here early on that was like, you're never going to get any appreciation in Texas. Like, just count on 3% a year.
Yep.
Your property's got a cash flow. This is a friend of mine that has like 1,000 houses here in Dallas. And he was wrong. Like,
That's changed.
My properties have never really cash flowed that well, but the appreciation's been insane. Like, nobody could have imagined that.
Yeah, he was right when he told you that, though.
Well, that's what I should have. Yeah, you need to buy them.
Way for a long time. This was like the S&P 500. It was stable as hell. And my house, I've lived in it for, how long have you lived in your place?
Like 15 years now.
Okay, I've lived in mine for 8. And mine's double what, the houses around me that sell that aren't even rehabbed like mine is, sell for double what I paid for mine. Yeah. And that's just 8 years.
Right. Yeah.
You got to think, though.
But I have a 10-year mortgage. I refinanced in 21. So, then it won't be long before it's paid off. I don't have to worry about it.
Well, you got to think, if we get the 50-year mortgage, a couple of things. If you're going to push that product as a mortgage company, how do you incentivize your team? Number one. And then how are they even going to underwrite that for insurance moving forward? Like, hey, we have we got obviously closer coverage, right? Let's say if it was Todd and he's like, all right, we can insure this, but now it's at 50, it's like, well, that changes all the underwriting for us.
It might, because they're probably presumed to have less equity.
Well, and insurance. I happen to own an insurance company, but I don't know a lot about insurance. I have a great team over there, and I'm just an owner manager. But in insurance, recently they have changed the deductibles from 1% to 2%. It's really been rough on the roofing industry because the folks in the roofing industry used to save you a deductible. It'd be like in cars, I can save you a $500 deductible, a $2,000 deductible. I may not be able to save that on some auto body work, Yeah. So it's the same on roofs. And so that is interesting because in 50 years, who knows what insurance rates could be, you know? And what's crazy is 50 years from now, who knows what property taxes may be, or they may not exist. Some places are starting to get rid of them. So there's a lot of infrastructure. It's a good point, Kevin. There's a lot of infrastructure that's got to be put in place to be able to, hey, I can give you a 50-year mortgage, but if there's no 50-year insurance, then there'll have to be an exception. Hey, you got to re-up your insurance every 10 years because they'll only give you a 30-year policy or something like that. So,
well, we'll see how this plays out. You know what sounds worse than this, though, is a 15-year car loan.
Yeah.
Talk about not having equity.
Yeah, no kidding. And it's the same play, though, isn't it?
Yeah.
And the same thing.
I hate to pay 15 years on a car.
What car do they make right now that's going to last
15 years? That's right,
Crazy. Could you imagine the cars busted and disgusted and you're still paying on this thing?
You know who's going to take out 15-year car notes? Altima drivers. The chicks that drive those Nissan Altimas with like every door ding and every door panel, you're going to start seeing Altimas down the road. You're going to be 15, 15, 15. You know
they still run like a top, though.
Dude, you can't break them. That's what I'm saying. Those will, and Toyota Camrys, those will work because they're the only cars that last 15 years,
Yeah. It's hard to imagine that. Hopefully that one does not happen. That's a little crazy.
Yeah, I just traded out of a truck that I've had for 6 years, longest I've ever had any vehicle. First vehicle I ever paid off and like owned, and now I own all my cars, but that was my first one. And 6 years into it, 80,000 miles, shit starts falling apart, being expensive. I had to get rid of it. I couldn't imagine if I'd financed that thing but when I traded it in, this was great. I paid $70,000 for the truck 6 years ago. They gave me $50,000 for it at the dealership. So I felt like that was a pretty sweet deal, And I bought a $90,000 truck, and the there's no way like I was looking at them, just payments on the difference between the $40,000 was like $1,800 a month or $1,500 a month on a 3-year note. I ended up paying cash for it, but I'm like, dude, that's crazy. Could you imagine having to pay $1,500 a month for 15 years on something? Like,
yeah, wow.
I remember my first two cars. I just paid them outright. I was like, hey, my first car, coming out of college, second car outright. My Jeep, all right, we have a few years left on it, but 15 years. So if you
5 feels like forever.
yeah, absolutely. I'm looking. I'm like, stop. I'm looking. I'm like, man, I'm so tired of giving y'all money.
Yeah.
Like, what does it cost? Like, do I get like a discount if I pay you off early?
Oh, hell no.
No.
Yeah, do I get a discount?
No, you're making too much sense, sir. Please stop
know.
having logic on this call.
Well, entrepreneurs use these as tools, right?
Yeah.
I remember you just talking about, you said a Jeep, and I thought of my wife has a Rubicon that we just paid off, but it was a 5-year loan, but it was 0.9% interest when we got it, and I was like, that makes sense. Like,
Yeah,
we could have paid cash for it, or we could have whatever, but it's like, this is like free money, and clearly it has been over the last 5 years. Been a ton of inflation, right? But let's talk about let's kind of shift and talk about just entrepreneurs using debt, like how they use that. Obviously, you guys help a lot with working capital and a lot of other stuff that entrepreneurs need. And so we started this off talking about the 50-year mortgage. That really is probably more of a play for owner occupants, right? To make it more affordable. Investors find ways to use different tools and still make their business move forward. So like what's working now? I know you talk to people a lot about, obviously, want people to be smart with debt, but it's a tool that most entrepreneurs need one way or another to fuel their business from where they're at to where they want to go.
Yeah, to consumers, debt is a shackle. To investors, debt is a tool. And I'm sure your audience is who's largely investors use debt as a tool. What most people end up, especially in the real estate world, what most people, they got a hard money lender that they use, and they've got their ratios and qualifications that the property must make and down payment and all that stuff. And I see a lot of people get put in the I would buy more houses, but I don't have access to more capital. All my money's tied up over here. All my money's tied up over there. And I go to Bank of America and they won't give me any money. I go to Chase and they tell me that they don't like the type of business I'm in because we do fix and flips and holds, or whatever the case, right? It's the same old story for every entrepreneur, whether you're a real estate investor or whether you're a plumber, right? And so, there are a lot of, and this is the fastest growing segment of the financial industry right now. Like last year alone, it was only $8 billion in business that was done, right? So this is still in its infancy stage, but there is a lot of talk about private equity in the real estate and the business market lately. There's a lot of private lenders out there that aren't Chase Bank, that aren't Wells Fargo, that don't have a fancy website, that aren't running Facebook ads, that have a lot of money to lend to owners and investors and operators. And like at Closer Capital, we tapped into, I wanted to build something that was you can go to us for all things money. What always bothered me was I've got a mortgage guy, and then I've got a commercial lender, and then I've got a hard money guy. It's like, and they're all cool. 3 friends of mine, they're all guys, but it'd be much easier for one person to have all my stuff central command for everything that I need.
Right.
And so that's what I set out to build 2 years ago. We're a fairly young company, Closer Capital, but that's why I set out. What investors haven't had prior to this conversation that we're having now, what they haven't had access to was to be able to borrow for their down payments or to be able to do creative financing things. So let me give you a scenario here. So if you've been an investor for 2 years at the same LLC, now I know a lot of us will get an LLC per property, right? Just for protection, personal protection on that property in case something goes wrong on the job site or whatever the case may be. But typically you have some blanket LLC that all your cash is eventually traveling up to. You can go take that to a company like Closer Capital, and we will loan you typically 125 to 150% of your average monthly gross top line revenue. So if you are we take 6 months to 12 months of your bank statements. If we take 6 months, we average it out and you make $100,000 a month on average deposits into that bank account, then we can give you either working capital or a line of credit of up to $150,000, somewhere between 100 and 150, depending on what your bottom line cash flow and some of these other factors. Well, what does that matter for an investor? Well, if I can go get a line of credit or just a lump sum term loan of money, and I'll use the line of credit as an example. If I can go get a line of credit, and let's say that the interest rate on that line of credit is 12% annually, that's 1% a month per whatever you're drawing on that line. So if I go and I put 35% down on a fix and flip, I borrow the money against my line of credit as the down payment. Okay, because it's cash whenever you want it in your bank, use that as down payment. I've got it. In our case, our hard money rates are about 8%. So we got about an 8% interest rate over here that we're only going to pay for 6 months max anyway. So it's really 4% interest rate if you actually annualize it and think about it that way. And if you sell this house in 4 months, you've only paid about 4% in interest on the down payment money that you came in there. All the while, you've got your own capital still sitting in the bank account. Now you're playing with the house's money, and you've got your money sitting in the stock market, sitting somewhere where you can pull it in and out of quick if you need it, right? Now, then the line of credit that I give you for $100,000 in this instance, you paid it off in 4 months, you go find another house, do the same process again. That $100,000 line of credit could be $300,000-$400,000 worth of line of credit before the end of the year. And on top of that, it could have made you another $100,000, $200,000, $300,000 in flip money or whatever it is that you're using it for. I call that building a moat. The moat is something I took from Warren Buffett. You know, he says you got to build a moat around your finances, right? So you got your main finances and you have to build layers of protection. I even wrote a book with my own thought process around this called Bulletproof Business about 10 years ago. And so an investor moat needs to be, and we call it the investor arsenal. It needs to be a line of credit or working capital. So let's say you don't need the working capital right now. So it would be foolish to take it and be making payments on a term loan, but we can close in 3 days or less. So you've got a contract on a property that needs to close in a week. You hit a term loan with us. It's the down payment money by the time that contract closes over here. And now you're off to the races, pay both of them off when you sell the property. Minimum. In a lot of cases, even on term loans, you get 20 to 40% discount on the interest for paying it off early. So this is ideal. On top of that, we offer business credit cards at 0% for 12 months locked in, around $250,000, even for sometimes startup businesses. So if an investor can have $250,000 at 0% here, they've got a line of credit for $100,000 over here, and they've got hard money between 8 and 12%, depending on if they use us or the competitors, then they've got an arsenal of playing with monopoly money. Meanwhile, every time you get real cash, put that back in your bank account and don't use it on any of the projects. So that if all else goes to fail, our loans are non-recourse, they're non-collateralized, they don't report on your credit. So if all else fails in a project, the bank's holding all the chips and you still got your cash over here.
Yeah. What you mentioned my son up front. I was talking to him. Surprisingly, he's 18 years old now. We started flipping houses when he was 1. So we flipped hundreds of houses, but he didn't pay very close attention. Now he's paying a little more attention because he's trying to figure out what he's going to do with the rest of his life. And so we just had this conversation a couple of days ago about how he's like, just the money thing came up. And I was like, well, we've almost never used our own money. We have on some smaller deals, but like we always borrow money, usually from private investors or hard money or whatever, some local banks. And he just couldn't get over like, why don't you use your own money? I was like, well, why would we? I mean, it's not, and by the way, you know, for entrepreneurs, you're generally not sitting on a bunch of cash,
right?
Like my money's busy doing something else, right? And so, but you got to use it wisely, right? It's easy for entrepreneurs to start to commingle stuff, and next thing you know, they're paying for stuff that they might not get back, or you know, they could be paying for it to cover overhead costs instead of investing in equipment or investing in other things. So, what kind of guidance do you give entrepreneurs to use it wisely and not get hooked on that cheap credit?
There was a study done by Kipling, I believe, and recently, and they studied a bunch of people with $5 million net worth, like no more, no less. This was the batch that they picked from. The average balance they had in cash was $280,000. Yeah. These are people with $5 million. You think, shit, he's worth $5 million. He's balling. And in equity, yes, on paper. Matter of fact, there's an interview. I think it's the same one we were talking about earlier with Elon Musk. And they were like, but you have $1 trillion PayPal. And he goes, yeah, on paper. I don't have $1 trillion I don't have $1 trillion in my
like
bank account.
A vault somewhere with cash. Yeah.
Yeah. I remember there was a time where, I was going through some real financial struggles. I had a crazy tax bill. I had a crazy overhead in my construction bill in my building. And I had like $15 to $18 million worth of debt that I'm paying on. I mean, real estate debt, obviously not like personal debt or whatever, but real estate debt that I'm paying on. And going through a really, really tough time financially. And that was enough for me to be like, you know what? I don't like the pressure of having to deal with all of that, right? And in the last 2 years, man, I have gotten out of almost $20 million worth of debt just selling real estate. You know, I'm down to my last 2 houses, got rid of my building. And I say all of that because, you know, my kids are kind of the same way. They've seen us flip houses our whole life and been on a lot of, you know, projects and stuff, and are just now starting to pay attention there in their teenage years. And, you know, I think discussing what you're doing with them and showing it to them and letting them understand the flow of money and how it works and explain, like, why wouldn't you use your own money? It's like, well, because this is how I teach mine, because there's these things called margin. And that's between the margin of the money that I can use from somebody else and what I can make in the profit. And if I use my money, I might have a 10% margin. But if I use the bank's money, I might have a 6% margin, but I don't have any risk. So my risk is eliminated. So it's like an insurance policy. And I explain it to them in detail like that. They're starting to get it, you know? And you know, what's crazy is a lot of business owners and even a lot of real estate investors, they think they know finance, but they know from their one small corner of it. I've done a bunch of hard money deals, so I know exactly how this is. And and it's just like anything else. We get in a routine, and then that keeps us from thinking outside of the box. You know?
I think just being a finance guy, you think you know finance like you're talking about until you start working on the lending side, and then you see how not just real estate investors, right? You see how roofing company owners, you see all these different owners talking about the cost of the money that they're leveraging, right? That's always the number one topic. Anytime we're right about to close a deal, I know it's coming. I'm like, hey, if we didn't pre-handle this question right now, it's coming up. I know it's coming. So how much does it cost for us to hold? Now they're doing their own math, you know, trying to do APR, and you're thinking, like, this guy must be smart. He, you know, his roofing company is worth $250 million, and then you start seeing how he breaks down the numbers. Like, wow, he's really not disrespectfully, he's really not that smart of a guy. What he's, you know, going back and forth with us.
He's looking at it through the wrong lens.
And he's going back and forth for like, it's like you're not understanding what I'm saying to you, sir. This is not how much it costs. Well, it says it on paper. Yeah, if you go that far, it's going to cost that much. But I don't, that's too much for me. You just said you're going to keep this for 4 months. Can you put that in writing? It is in writing. You're just looking at it from the whole perspective. And then you also got to think about, you know, when you're older, I don't know about you guys, my family, you know, I'm a first generation American, and I was evicted twice as a kid. So the level of financial competency in my family, love them, it's really not that high. Okay. So these conversations, I have to go into work to talk about these conversations, because anywhere else it's like the basic. I'm talking about base level conversation. So when you start breaking down the margin of why you want to borrow money, if you say it to the wrong person, they're thinking, oh my God, it's so expensive. Even to invest, there's levels to that. There's levels to what they know.
Right.
They're thinking like, hey, this is 10%. That's all they know is 10%. What are you going to do with that 10%? If it's 10%, it might be actually good for you.
Yeah.
You know, if you can make, I remember one time you said, hey, look, what the hell is 10% if you're going to make, you know, what the hell is 100 and pay back 100 again if you're going to make $1 million off of it? You know, they're like, yeah, but it's still, there's like, what you made 900,000. What do you,
don't get caught up on that.
Yeah. You know, what are you mad about the numbers? You know, I could get if it was like, there was no margin, but bro, you're 10Xing your money. So just the dichotomy of like how money works it's I don't care who you are. Now that I've seen it from the lowest of lows to this guy's making $500 million and he still don't know nothing about how
there's some people that just step over dollars to pick up pennies, you know.
Oh man.
Yeah. It's cool.
Well, you know, now you know the ham story. from Zig Ziglar, and now you just see you're just like, let me tell you the story about a ham, and you just tell them that story and go, who told you to ask me about interest rates? Are they a financial expert?
Oh,
allow me to enlighten you with, and I'm going to make you better. I'm going to make you better for the next bank too, with what I'm going to educate you on, because that's what it is. It's like, get them fixed on this interest rate, but a 50-year note is like a 400% interest rate, So
yeah. Hey, so if folks want to learn more about Closer Capital or connect with you guys, where do they go?
Closercap.com. Every question that you could possibly have, anything you need to know about a loan, what it takes, what the qualifications. We have calculators on there. Everything you could possibly. This website is an arsenal for people that need financing. So any question you have, it's right there, easy to navigate. Can also apply and get instant approvals with us. Closercap.com.
Awesome. Thanks for joining me today, guys. Good to see you.
You probably get a call from Kevin.
Yeah. Yeah.
Mike,
awesome.
thanks for having us, man.
Yeah.
And I want to say this before we end the show, because I think it's worth saying in front of everybody. I'm a very judgy person, and because of my past, and but one of the ways that I judge a man specifically is by their children, and you have an exceptional son, so that really in my eyes means that you're a very high quality man, because sometimes somebody like you and I at events and stuff, and you don't know what you do when you go home or whatever, but then you can meet somebody's kids and see really how they are and how they showed up for them. So I just wanted to honor you with that,
I appreciate
man.
that. I was going to try to sell you a 50-year morttage, but I'm not going to do it now.
Appreciate it, man.
Thank
You wouldn't make no more money off of it anyways.
I guess not. I thought I would. Yeah. Awesome. Well, thank you, guys. Guys, hope you enjoyed today's show. There's a lot of ways to use credit in your business as gasoline to fuel your growth, right? So if you want to learn more about Closer Capital, make sure you check out the link down below, closercap.com. Appreciate you joining us on the show. We'll see you on the next one.
Thanks for joining us for today's show. You can learn more about the amazing benefits of the Investor Fuel Mastermind community, including surrounding yourself with hundreds of other rock stars, 100% financing on your deals, and members-only discounts from vendors you're likely already using that, as a member of Investor Fuel, will save you more than the cost of your membership. Visit investorfuel.com to learn more. You can also check out the show's notes for access to free resources, how to get access to world-class lead generation, and even how to work with me directly one-on-one. Don't forget to subscribe so you never miss another episode. See you on the next show.